Assets. Assets are divided into two types. One, liquid assets, which are used for down payment and closing costs. And two, long-term assets, which can be used to cover the 2 months' payments required for reserves. To verify the borrower's assets, you can use bank statements, investment statements, and verification of deposits. Down payment options. Cash cannot be used unless it is deposited into an account and has at least 60 days seasoning. Verified deposits in checking accounts and savings accounts are most often used for down payments. An additional down payment option would be a gift from a blood relative or significant other and a letter that shows no requirement for repayment. There are also down payment assistance programs that assist first-time homebuyers. The assistance could come from city, county, or state programs. Income. There are two types of income, stable income and variable income. The income is verified with 1099s, W-2s, pay stubs, tax returns with a 4506T as required, and a verification of employment. 2-year history is required to provide continuity of income. Non-taxable income can be grossed up by 25%. An example of non-taxable income would be Social Security benefits. A borrower is considered self-employed if they own 25% or more of a company. There's a lot of additional analysis for self-employed borrowers to ensure continuity of income. There are 6 income calculations that are essential to know when we are talking about calculating income. If the borrower is paid annually, the calculation is annual gross income divided by 12 months. If the borrower is paid monthly, there is no calculation. If the borrower is paid twice monthly, for example, they are paid on the 5th and the 25th of the month, the calculation is the amount of each paycheck times 2 pay periods. If the borrower is paid biweekly, the calculation is biweekly gross pay times 26 periods in a year divided by 12 months. If the borrower is paid weekly, the calculation is weekly gross pay times 52 pay periods divided by 12 months. If the borrower is paid hourly, the calculation is hourly gross pay times average number of hours worked per week times 52 weeks divided by 12 months. Liabilities. All liabilities must be disclosed by the borrower if they are not on the credit report. Any payment on liabilities that has less than 10 payments left does not have to be included in the ratios. The exception is a leased vehicle. Payments that are not considered liabilities include things like utilities and cell phone payments. Ratios. When calculating ratios, the front end or housing ratio and the back end or overall ratio are used. Each of the agency products all have different ratios to qualify the loan. Conventional ratios are 28% front end and 36% back end. FHA ratios are 31% front end, 43% back end. VA has a back-end DTI of 41% with residual income calculation. USDA ratios are 29% front-end, 41% back-end. Loan-to-value. Loan-to-value is considered a qualifying ratio. The maximum LTV, or loan-to-value, on the programs we discussed are conventional, 97%, or a 3% down payment. FHA, 96.5% with a 3.5% down payment. VA, 100%, no down payment is required. And USDA, 100% with no down payment required. Credit report. The credit report that is pulled for underwriting a loan is called the tri-merge, the merging of the 3 credit agencies: Experian, TransUnion, and Equifax. The underwriter will use the middle credit score when underwriting. Credit scores range from 300 to 850. Bankruptcies show on the credit report for 7 years on a Chapter 11 or Chapter 13 and 10 years on a Chapter 7. For a conventional loan, if a borrower's credit report shows that a borrower has been 60 or more days late within the past 12 months, the underwriter will deny the loan unless there are extenuating circumstances. Also, for a conventional loan, a borrower is prohibited from obtaining a loan if they have had a foreclosure reported on their credit within the previous 7 years. If there is a short sale and not a foreclosure, the borrower must wait 4 years from the short sale to obtain a new mortgage. Inquiries remain on a borrower's credit report for 2 years, but most of the time the score only takes it into account for 12 months. FCRA, or FCRA, the Fair Credit and Reporting Act, also known as Regulation V, is a federal law that regulates how consumer credit reporting agencies, or CRAs, use consumers' information. Under FCRA, all consumers have the right to one free credit report each year. They can get more if they pay for them. The credit pulls must have a permissible purpose. You can't pull someone's credit just because you want to. FCRA requires that most things are removed within 7 years, 10 years on bankruptcies. FCRA requires an adverse action disclosure. This disclosure must be given within 30 days of a credit decision. FACTA, the Fair and Accurate Credit Transaction Act, is an amendment to FCRA and adds provisions to improve the accuracy of consumers' credit-related records. FACTA requires the provision of risk-based pricing notices and credit scores to consumers whose applications are denied or who receive less favorable offers of credit. Notice to home loan applicant is required under FACTA. Safeguard rules require all files to be kept confidential and stored in a locked cabinet or drawer when not in use. All files must be kept for a period of at least 3 years before being destroyed. The CD, or closing disclosure, must be kept for at least 5 years. The Economic Growth, Regulatory Relief, and Consumer Protection Act requires nationwide consumer reporting agencies to provide national security freezes free to consumers. It also provides security and credit freezes. This amendment extended the time that a borrower can have a fraud alert on their credit report from 90 days to 1 year. The red flags rule was established to prevent identity theft and applies to financial institutions and creditors. The disposal rule is part of FACTA and dictates how institutions should dispose of consumer information. All files can be destroyed after 3 years, 5 years for the CD. Hard copies can be destroyed if all the files are digitized. Tangible net benefit. When analyzing a borrower to decide if they should get the loan, it is necessary to determine their ability to repay and if there is a tangible net benefit. As a professional, it is an MLO's responsibility to discuss options and determine if it is the best decision to complete a loan transaction. RESPA, the Real Estate Settlement Procedures Act, also known as Regulation X. RESPA covers kickbacks, referral fees, escrow requirements, transfer of servicing, and TRID. Section 8 prevents anything of value being exchanged for referrals or kickbacks. RESPA does not cover vacant land, large tracts of land, which include 25 acres or more, even if there is a dwelling on it, commercial or business loans, the government or its agencies, temporary financing, bridge loans or swing loans. Under RESPA, an affiliated business arrangement disclosure is needed if the MLO or company has an interest in third-party companies or if you are requiring a borrower to use any of your referral companies. USA Patriot Act. The USA Patriot Act was created in response to the attacks of September 11, 2001. The Treasury Department, through its Financial Crimes Enforcement Network, or FinCEN, became responsible for implementing the act. As part of compliance with the USA Patriot Act, financial institutions are required to check 2 forms of identification for each borrower. The USA Patriot Act requires MLOs to obtain borrowers' identification through a Social Security card, a passport, or a driver's license, and then run the borrower through the OFAC database to see if they are on the government's watch list. Appraisals. An appraisal is an evaluation of the borrower's home determined by the appraiser and substantiated by an appraisal report. All appraisers must conform with USPAP and be licensed in their states to perform appraisals. The use of an appraisal management company, or AMC, is required by Fannie Mae and Freddie Mac. They are a neutral third party. There are 3 types of appraisals: sales comparison, cost approach, and income approach. The sales comparison approach is the most common and uses comparable properties to determine a value of the subject property. Comparables must be within 1 mile of the subject property and have been sold in the past 6 months. Cost approach appraisals are determined by how much it would cost to reproduce the improvement, the home, on the property. The income approach is used mostly for investment or multi-unit properties. The amount of income the property can produce through renting is used to determine the value. Title. Title is a collective term for all of a borrower's legal rights to own, use, and dispose of land. The title report is a generated report that shows the chain of title. The chain of title is the chain of the sales and transfers of ownership of the title. Title insurance protects the borrower and the lender from any flaws in the title from the date of the closing and before. There are 2 types: owner's title insurance, which protects the owners, usually not a requirement but a recommendation, and the lender's title insurance. It's always required on a transaction as it protects the lender. An easement is a legal right to use another's land for a specific or limited purpose. A restrictive covenant is a clause in a deed or a lease to real property that limits what the owner of the land or lease can do with the property. An encroachment is when a property owner violates the property rights of his neighbor by building something on the neighbor's land or by allowing something to hang over onto the neighbor's property. A deed is an instrument that conveys a grantor's interest, if any, in the real property. Ownership in severalty is the simplest form of ownership. It's ownership in a sole form, meaning only one person owns it. Co-ownership, also known as a concurrent ownership, is the ownership of a property by 2 or more persons who share title to real property. Tenancy in common is a form of co-ownership with 2 or more persons having an undivided interest in the entire line, but no rights to survivorship. Right to survivorship means that the property passes automatically to other co-owners when one co-owner dies. Joint tenancy exists when each co-owner has an equal, undivided interest in the land with the right of survivorship. Tenancy by the entirety is a form of co-ownership that involves only owners who are legally married, with each having an equal and undivided share of the property. A lien is not only a financial interest in the property, it is also a financial encumbrance and can be voluntary or involuntary. A note, a promissory note, is a written, legally binding promise to repay a debt. Default is the failure to fulfill an obligation, duty, or promise, as when a borrower fails to make payments on a mortgage. Generally, liens are paid in the order they were attached to the land. The important exception is a property tax lien. These types of liens are superior to all other liens. Insurance. Insurance requirements for homeowners insurance, hazard insurance, and flood insurance are as follows. Borrowers must have both if required at closing and paid up for the next 12 months. When a property is in a flood zone, most lenders are going to require that the borrower obtain flood insurance. The Federal Emergency Management Agency, or FEMA, is responsible for creating 100-year floodplain maps and providing flood insurance to homeowners in identified flood zones. Maximum flood insurance is $250,000 for the property and $100,000 for personal property. The 1973 Flood Disaster Protection Act regulated and required insured lenders and federal agencies to require flood insurance for loans for properties in special flood hazard areas, SFHAs. That is the end of the Chapter 4 review.